G'day investors, my name is Kras. Welcome back to the channel. In this video, I'm going to talk about why I sold my shares in Wesfarmers last week and picked up a few shares in Washington H. Soul Pattinson. In addition, I'm going to go over why I decided to keep the remaining cash on the sidelines and wait for better opportunities. If this interests you, stay tuned. Right off the bat, guys, I want to say that Wesfarmers is a great company, and I didn't sell Wesfarmers so much because I don't think it's a good company, but I sold it because I think that there's going to be a lot of market volatility and I want to reduce the volatility in my portfolio. And as we're going to find out throughout this video, you'll see that Wesfarmers is a far more volatile company than Washington H. Soul Pattinson. So this image here that you can see in front of you basically shows you how many different companies each of these conglomerates own. You can see that Wesfarmers own 26 different companies, all of which are individually managed and operated independent of Wesfarmers, however obviously influenced by Wesfarmers management. So if any of these companies are not performing, Wesfarmers management will go in there, maybe restructure it, or maybe implement new practices to get those companies back on track. We can see that happening right now with Kmart and Target, which are going a rebranding and a restructure. On the other hand, Washington H. Soul Pattinson prefers to buy large stakes in already existing businesses. So you can see that they do have a couple of 100% full ownerships in Round Oak Minerals, in Pitt Capital, and a couple of other investments, as you can see there. In terms of size, they're very different. Wesfarmers is 10 times larger with a market cap of $48 billion, and Soul Patts has a market cap of $4.6 billion. This fact had nothing to do with my decision to sell Wesfarmers and buy a little bit more of Soul Pattinson, and the future prospects of their subsidiaries like Bunnings, Catch.com.au, Brickworks, TPG, so on and so forth. That really didn't have a lot to do with my decision to sell, as we're going to see. Inherently, I do believe that both companies and all of their subsidiaries have excellent prospects, considering a lot of the products that they produce, a lot of the services they provide are essential services and essential products for industries and for consumers. And I highly doubt it. If you're Australian and you are listening to this and watching this video, I highly doubt that you haven't interacted with one of these subsidiaries at some point in your life. So you get the idea. They're very diversified companies. Their management is very experienced in acquiring and managing those subsidiaries. So how have their managements performed in the past? So this video is going to be more of a look at the past and try and crunch that data and figure out what we're actually looking at and which is a better company to hold for the long term from a risk adjusted perspective. So in this next chart, guys, we can see that the ASX the ASX has returned an average of 9.22% per annum. If we then take Wesfarmers and Soul Pattinson and compare it to the ASX, we can see that from the period of 1990 to basically right now, 2020, that Wesfarmers have had a total return of 2,754%, Soul Pattinson a total return of 2,448%. On an annualized basis, these returns work out to 11.69% and 11.25%. So we can see that the bottom line there is telling us that Wesfarmers and Soul have respectively outperformed the ASX by 2.47% and 2.03% each year. That is very significant, and that is quite comparable. Obviously, Wesfarmers have done a little bit better over that particular period, but the question that I had in my head was, have they done better on a risk-adjusted basis? And I wasn't convinced of that, and that's the main reason why I sold Wesfarmers. Now, the other reason why I decided to sell Wesfarmers has to do with the current situation and the incredible market volatility that we're experiencing. I had quite a bit of money tied up in Wesfarmers. As you can see from the start of the video, I had about $21,000 in the company. So by selling it, I freed up that money, made a tiny profit, and now I have a little bit more cash on the side to react to any further market volatility. Now, this chart that I've brought up in front of us is that 20-year chart of their stock prices. As we can see from the global financial crisis, Wesfarmers crashed a lot harder than Soul Pattinson, and in fact, Soul Pattinson has a much lower volatility in their stock price than Wesfarmers. So they have a very comparable return, they have a very comparable outperformance of the market each year, but one has far less volatility. So from a perspective of capital protection, I definitely feel that my investment is a lot safer with Soul Pattinson. If we take a look at the consistency of their dividends now, we can see that Soul Pattinson has had an incredibly consistent history of dividend payments, and we're going to find out eventually why that's the case. And it has to do with each company's use of debt and their use of issuing new shares. If we look at Wesfarmers, they have an upwards trend of dividends over the last 7 to 8 years, but it's a little bit choppy. And as we're going to see, some of those dividend payments have been funded by debts, not by retained earnings. So this was another big issue for me with Wesfarmers. Now, I'm not saying that I know what the future is going to hold, but I do believe that Wesfarmers is going to have a lot more volatility in their stock price than Soul Pattinson. And from my perspective, from my overall portfolio perspective, which I'm not going to talk about in this video, I felt that Soul was a better fit in my portfolio. So if we just take a quick look at their self-proclaimed returns against the All Ordinaries Accumulation Index, you can see that from 2004 to 2019, Soul Pats had a return of 419% versus the All Ords 267%, and Wesfarmers had a return of about 450% compared to the All Ords 250% return from 2009 to 2019. So again, whatever their management's doing, they're doing a very good job at outperforming the stock market. At the end of the day, whether you guys decide to invest in Wesfarmers or whether you decide to invest in Soul Pats or both, you're making an investment in their management team, and you're making an investment in their management team being able to continue making good investment decisions into the future, well into the future, as they have been doing so far. If we look at how these two companies have made all of these big acquisitions over their history, it becomes apparent by taking a glance at their ordinary shares outstanding chart. You can very, very clearly see here that Soul Pattinson has barely issued any new shares at all, whereas Wesfarmers have very happily issued many new shares. You can see from 2001 to 2002, the number of shares outstanding for Wesfarmers jumped up quite drastically, and that was because they acquired Howard Smith for $2.7 billion, including their what's now called Bunnings hardware network. Their Bunnings investment turned out to be incredible, coupled with the luck of Masters making a few bad international investments and Masters going out of business. Now Bunnings basically own Australia. If you're an Aussie in Australia and you need to buy some tools or some materials, you have to go to Bunnings. There's pretty much very limited alternatives. Fast forward to 2007, 2008, you can see a gigantic increase in the number of shares outstanding of Wesfarmers, and that of course was when they made their takeover offer for Coles Group for $20 billion. As you can see, Wesfarmers is very, very aggressive when it comes to acquiring new companies, and they really don't play around. They literally set records on the ASX for acquiring other companies. Soul Pattinson takes a more conservative approach. They don't go in with all guns blazing. Soul Pattinson uses their existing retained earnings, and they use debt to finance their investments. So you could almost say that Soul Pattinson acquires companies in a more organic manner than Wesfarmers, which uses their management know-how, investment banking experience to convince shareholders of very large companies, existing companies, profitable companies, that if they get acquired, if they get restructured potentially, that more value can be extracted from that acquisition. So at the end of the day, to me, it seems that Wesfarmers is a lot more aggressive than Soul Pattinson in growing their portfolio of subsidiaries. Now, going to the financials and the debts in particular, if we look at the last 10 years, if we look specifically at the interest-bearing loans and borrowings of Wesfarmers and Soul, and ratio that to their net profit after tax, what we can see is a very, very concerning trend with Wesfarmers, where it will take them basically 3 years of retained earnings without paying any dividends to pay off all of their existing debts. So if they wanted to currently pay off their, the latest figure that I have is $3 billion total debts. If they wanted to pay that off, they would have to suspend their dividend payments for effectively 3 years before they pay it off. Now, contrast that with Soul Pattinson. Their ratio is 0.46, let's say it's 0.5. Soul Pattinson can pay off all of their existing debts in half a year. That's incredible. They're in a much stronger financial position than Wesfarmers. In fact, they're almost in a 6 times stronger financial position than Wesfarmers. I find that to be very, very attractive from a risk-adjusted returns perspective when you consider going back to the initial chart, where they have very, very similar outperformance of the ASX, but one company is financially a lot sounder than the other. If we turn to the dividends paid, right, and then we do the same thing and we take the ratio of the dividends that these companies pay each year to their net profit after tax, we can see a very concerning average with Wesfarmers, where their average is 1.43. Well, what does that mean? That means that 1 out of the 1.43 is coming from their returned earnings, which is their NPAT. The 0.43 is coming from debts. There's no other place where that money can come from. So that is, in my opinion, very financially irresponsible of a large company like that to appeal to dividend investors, to appeal to its investors and pay them dividends out of debts. And look, we might have to get into corporate finance theory and tax shields and the price of their debt, but at the end of the day, that is not very sustainable. You have to agree that's not sustainable in the long run. Soul Pattinson is sustainable. They are paying their dividends from their retained earnings, and they're keeping a bit extra on the side every year. So on average, they're paying out 84% of their net profit after tax as dividends, and they're retaining 16% on average to reinvest in other ventures, which is going back to what I said before, that they have a far more organic approach to their strategy. So at the end of the day, which is better? So far, you might say Wesfarmers have done much better. They've provided slightly greater returns than Soul, and if you're happy taking on that additional risk in the corporate structure with the debts of the company, then go ahead and invest in Wesfarmers. I feel more comfortable from a risk-adjusted perspective holding SOL in my portfolio. Now, of course, these are just my opinions. All of this data could be completely fabricated and wrong, so always do your own research. This is not professional advice. This is only my opinions, and this is just my passion, and I enjoy talking about this stuff. So having covered all of those points, we covered the historical outperformance, the volatility of the companies, the number of shares outstanding, the dividends that they pay, and we covered their debts from a risk perspective. I would love to hear what you guys have to say about this in the comments below. Thank you for watching so far if you made it till the end, and I'll see you guys in the next video.